Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I've got a pretty interesting video for you today. It's really a subscriber request video. 3 stocks that I've been often asked to cover, been reluctant to because of valuation issues. After all, I am Mr. Valuation. I'm going to look at today. I'm going to look at Palantir, which is maybe one of the most popular stocks on the planet. I'm also going to look at Eli Lilly, who is basically benefiting from the semaglutide weight loss craze. And then I'm going to look at NVIDIA. And these are probably 3 of the hottest, most popular stocks on the planet today. And what I'm going to do in the video is basically evaluate whether you should buy, sell, or hold any or all of these 3 superstars in the marketplace today. So let's go ahead and get into FastGraphs. Now, by the way, if you like this video, give me a like and subscribe to the channel for more videos like this, and also take a look at subscribing to FastGraphs. But I'm going to use FastGraphs to illustrate my positions on each of these 3 companies. So let's go ahead and get into the tool. I'm going to start with Palantir. And what I want to do is, because I get a lot of comments that to me, they're kind of strange because they really illustrate that people don't understand what they're looking at and what FastGraphs is trying to illustrate. FastGraphs are the Fundamentals Analyzer software tool. What they do is they organize on essential fundamentals at a glance, and they allow you to see the company behind the stock. And so all FastGraphs start with an adjusted operating earnings articulation. Now, this is Palantir's earnings since they went public in the beginning of 2021. Okay, the first year out, their earnings actually fell 32%. The second year out, their earnings fell 54%. But then in 2023, their earnings rose 317%. So you can see this large spike in earnings growth here. And that was followed by another pretty spectacular 64% in 2024. Now, growth is still expected to be very strong going forward, but not as strong as these 2 years. We're looking for 34% growth in 2025, followed by 24% growth in 2026, and analysts are forecasting 30% growth in 2027. Now, the light green shaded area indicates that these are estimates. The dark green shaded area shows that these are actual numbers. Now, on the FastGraphs, we can look at diluted earnings. And diluted earnings are interesting in FastGraphs. These are GAAP earnings. The company actually had made no money up until 2023. But diluted earnings have been pretty strong since. And we can also look at cash flow numbers, and we can look at things like EBITDA, which is another form of earnings, really, earnings before interest, taxes, depreciation, amortization. And then, of course, with a young company like Palantir, we're also going to look at sales. And you can see sales growth has been very strong. So what we're looking at here is the business behind the stock. And what we're doing is we're evaluating what the estimated future cash flows of these businesses can be. We're calculating what they've historically been and estimating what they could be in the future. So contrary to what a lot of viewers who view my videos say, these are not just based on history. These are based on looking at history and learning from history, and then forecasting into the future and trying to make your best estimates of what the future might look like, but then making your investment decisions based on what that future might hold. Now, this is going to be a high-level video, so I'm not going to get into all the ins and outs of each of these companies, but you can conduct your own research on each and every one of them. Now, Palantir is obviously an application software company, and I want to go back over this graph. First couple years, earnings were there, and they did make money, and I like that for a new company, but their earnings were actually dropping. And in 2023, they started to accelerate, and earnings are expected to continue to accelerate. Now, when I invest in a stock, I'm buying the earnings power of the company. And obviously, the Palantir's earnings power and past, present, and future looks very, very strong. Okay, but at what price are you willing to pay for that? Now, in theory, this orange line on the graph represents a PE equals growth rate formula made famous by Peter Lynch. He's saying for growth stocks, you want to pay a PE ratio that's equal to the company's growth rate. Now, normally I look at stocks with 15-ish PE ratios. With a growth stock like Palantir, I'm saying a 24 multiple based on the company's earnings growth would be attractive. But watch what happens when I take a couple of years off of the graph. Okay, I've gotten rid of those negative years. Now I'm looking at a 317% growth, followed by 64 and 30, 24 and 30, as I talked about before. But we also should agree that this number is probably an anomaly. A 317% growth rate is probably not going to be sustainable. So what we can do is take one more year off of the graph. And now we get a growth rate that is within reason of the actual growth rate achievements that have been achieved and are expected. In other words, we've got a 34% growth rate, a 24 and a 30, but we still have a 64% historically. So the future growth is not quite as high as the past, but it's still very, very high. Now let's do the thing that everybody wants to do. Let's price this stock and see if the stock is buyable relative to this growth. And so I'm going to put weekly closing stock prices on the graph. And what you see here clearly should be that the stock price has risen well above what the earnings justified fundamental valuation line. If this is the value line, the PE equals growth rate line, in this case of 37.17. That's what the PE is. Now we cap it at 30 with fast graphs, but we're going to show you where I'm going to use a 37 multiple here in a moment. All right, but regardless, this stock is trading at a very high valuation. Now, valuation is measured a lot of different ways, but when you look at the earnings yield, that's the inverse of the PE. Instead of price divided by earnings, it's earnings divided by price. We'll call it the EP rather than the PE. And what it really says in English is, and this is something people really understand, you buy a business you admire because of all this great earnings growth, hoping to participate in that growth. But if you overpay for it, you don't get a chance to participate in the growth. So what this is telling me is with an earnings yield of 0.52%, that if Palantir paid me all of the profits that they are currently earning, that's current earnings now, if they paid me 100% of their profits as a dividend, my dividend yield would be 0.52%, less than 1%. And obviously, we're dealing with a valuation. The PE ratio itself is 192 times earnings. In other words, we're paying 192 years in advance for this year's earnings. A 41 cents worth of earnings, we're saying we're willing to pay $83.42. That's rich. Now, the question is, where's Palantir's future and what should you be able to buy? Now, if I look at this back to a long-term graph, there was a time when Palantir got reasonably priced, even with 70 and 100 multiples relative to the amount of growth they were expected to generate. But let's go into the forecasting calculator because we're learning from the past. The company does have good operating history. There's no question about that. It doesn't pay a dividend. Okay, it's purely a growth stock. And the stock price did get real high here, and it peaked out up here at $120 a share, and it's now trading at 80. We can see this drop here. And already the drop has been relatively large. It's already fallen about 30% off of its peak. That would be an annualized number of around 100%. And the total annualized rate of return would be basically a 99% loss if it did continue to do that for the whole year. Obviously, that's an annualized number. But the point is, it did get ridiculously high and it's fallen. The stock is still volatile. It was now 1.77% yesterday. If I'm looking at it as I'm producing this video today, it's now back up 2.82% or 2.79% or 2.78%. In other words, it is a volatile stock. But the real question is, should this be bought? So let's go into forecasting and let's look at the expected growth. And we're going to use the P equals growth rate of 28.68. This is the price that that type of growth should command. Instead, the value is, as I already mentioned, 192 times earnings. It should be trading at 28 times earnings. And if it were to fall to that level, then you literally could lose almost 100% of your money. That would bring the stock down to like a $12 stock if it traded at that PE, which would be a very attractive PE ratio. So the point is, if you want to participate in a company's growth, you've got to be able to buy it when the price is at least in some reasonable relationship to the growth. Now, faster growing stocks like Palantir can be bought at a premium, but there's a point where the premium just gets absurd. And I believe that number is absurd now. Keep in mind, this stock was trading at a 278, almost 279 PE ratio in February of this year. It's now at 192 PE ratio. This is a very expensive stock. It's a great company. It has almost no debt, 3.7% debt. It has a really excellent sales record. In other words, the company is growing sales, but even if you look at price to sales, the normal price to sales in this stock has been like 26. It's currently trading at a 68 times sales. That's extremely rich, and people want to realize this is not the time to buy Palantir. Maybe back here when it was trading at more reasonable price to sales as a young company would have been a time to be investing in Palantir. And if I owned Palantir now, and I got this question on one of my videos, I'd at least take my investment out of it, and maybe my investment times two. Because let's say I bought it back here. I had one subscriber say they paid around 7. So I can't find actually 7. Let me try to get close. They're 758. Okay, and if you put $10,000 in it today, the investment would be worth $118,831. I might take $50,000 out of the stock at this point, do 5 times my money, and then let the rest roll. Let the other 68,000, whatever it is, roll if you wanted to take that risk. Or maybe the most prudent thing to do is sell all of it at this level. The point is, never be ashamed to take in a profit. But Palantir is one that I would be selling all, or at least taking my profit out. Even though it's very popular, you can see the stock has been under pressure lately, but it is a favorite of Wall Street, and it could do very, very well going into the future. Earnings-wise, I'm confident it's going to do that. Price-wise is a different story. I think we're paying a very rich valuation. The next one I want to look at is Eli Lilly. Now, there's a lot of lessons about investing in growth stocks that Eli Lilly can teach us. First of all, let's look at before the semaglutide craze. So let's use our scroll bar here and go back in time to when Lilly was really a kind of a normal company, and it was growing at about 6.5%. And at that time, it was given a fair value ratio of 15, and the market, even back here, there were times coming out of the recession of '08 that the market put a 7 or 8 multiple on the stock. And then we also had times where it put a 25 multiple on the stock. But then we can see, starting in 2021, a 17 multiple with 15 to 17 was kind of normal, with periods where it would be above that and below that. But then all of a sudden, it really started to deviate. Okay, but what also started to happen, if you look closely at the bottom of the graph, the earnings growth rate started to increase well above the 6.5% level. So let's move this back into more modern times, and we can see that now the growth for this period of time is 12%. But that's also made up of a lot of years where we had growth of 3%, 39, 31, 3 or 4 negative years in there where the earnings did not grow at all. They actually shrunk. But coming with the semaglutide craze, we see that this stock has really had great growth. Now, looking at it from this perspective, or even a shorter time frame perspective, where growth is now up to 23%, Eli Lilly still looks very, very expensive. But I've said this many times on past videos, you really can't overpay for a really powerful growth stock, within reason, of course, and lose money if the company delivers the growth that you're expecting. So let's shorten this time frame down to 7 years. Okay, and we still have years where it grew at 3%, 3% minus 20. So let's cut out those years and get it down into a current time frame. And all of a sudden we see that growth last year was 106%, expected 76% this year, followed by 26% and 27%. These are very strong growth numbers for an A-plus, very consistent pharmaceutical stock. All right, so if I go and look at forecasting now, should I be investing in Lilly? Well, the point is, Lilly has changed, okay? It was at one time a stodgy kind of pharmaceutical growing at 5 or 6%, as we saw by using my scroll feature here and scrolling back in time to where the stock prior to even COVID, it was a 5 or 6% grower. and kind of a stodgy stock. But then again, as we move forward, all of a sudden growth started to accelerate and the stock price followed suit. So looking at forecasting now, should we be buying or selling Eli Lilly? Now, we're capping this at 30, but using the P equals growth rate, as I told you I would talk about earlier, if we use the 37.9, we'll call it 38 PE. Well, I don't have a 38P here, but I do have a 39. So if I point my cursor to there and click on that, that would be trading at its current expected growth rate. Okay, in other words, if it generated this earnings growth that is expected by these analysts, and if it traded at a PE ratio equal to that growth rate, which is very common for high quality growth stocks, that's what growth at a reasonable price means. It means you pay higher than a typical value on an average stock, but for a growth stock, they call it GARP, growth at a reasonable price. Well, a 37 or 8 multiple would be a reasonable price for a company growing this fast. You could stand to make 16 or 17% a year. All right. If it traded at its normal multiple historically of 40, which is just slightly above that, once again, you would have an option of making double-digit returns, 13.5 to 18% out over the next 3 years, let's say. Okay, so is Lilly investable today? You could argue yes. If this semaglutide diet craze continues and the company continues to grow, then you could be investing in this stock. But I do want to emphasize, you're buying it with a very low earnings yield, but your current earnings yield, but you're buying a future earnings yield that's going to be much larger. And even though you're paying 60 times earnings if you bought it today, if it grows at 37 or 8% a year, again, the price can overcome that even if it does fall down to this valuation. Of course, if it stays above that, if it stays at its current valuation, you would stand to make 35 or 40%. So there is a risk-reward ratio here, but I do want to emphasize it's risky to believe a stock can continue to grow that fast, but that we're only talking about the next 3 to 5 years. So Eli Lilly, even though it's gotten extremely expensive, if I had bought this stock back in the day, I'd still be holding it today. I'd be reticent to buy it today based on that, but as I'm looking closer to the future, to where the stock is trading now and what type of earnings growth it's generating now, things have changed for this company. So now I'm thinking of Lilly as a 40 or 50% grower, at least a 30% grower, not a 6% grower. So Lilly is one that could be bought with risk. The caveat being is you're not buying it cheap. You're paying really full value or even slightly overvalued. But because of the power of compounding, it could grow itself back into value for you and actually make you some money. I don't think you should be getting a much higher rate of return than this would indicate. But because you're overpaying for it, you wouldn't get the full measure of the company's growth, but you would still be getting a very high rate of return relative to the normal stock out there. And then last but not least is the one that's probably the hottest stock on the planet, and this is the AI king, NVIDIA. And once again, very similar to Eli Lilly, we have this situation where normal growth for this stock over the years has not been anything like it is now until the advent of AI. Normal growth for this stock historically has been high, though. It was over 26%. And you can see coming out of COVID and the stock surged with some really strong earnings growth, we had this very high valuation applied to the stock. And then we had a down year in 2023, and this has a January fiscal year, and we saw the stock correct tremendously. And then once it got down here to a 30 multiple, all of a sudden, the last several years, couple of years, it's been running to the top. But again, if I shorten the time frame, we've got a very powerful growth story here, growing at 75 or 80% a year. Now that's extremely difficult. That's where the risk lies. From a forecasting point of view, analysts are only expecting an average growth of about 27%. Okay, but if it achieves that, and even though you bought it today at a PE, let's say 36, you could make 14 or 15% a year on your money. If it traded at its growth rate of 27%, you could make double-digit returns, all right? The normal multiple for this stock over this time frame has been 48. If it would continue to trade at that premium, you could stand to make 40% annualized on your money. So this still is a powerful growth story. Again, it's not cheap. You're paying a very high price for it, but because of the power of the growth potential of this stock going forward. By the way, looking at the analyst scorecard, it's got a really excellent analyst scorecard on a 1 year and a 2 year. They only missed earnings 9% of the time with a 1 year forward, and they exceeded it 73% of the time on a 2 year forward estimate and hit it at 27% of the time. So that should give you some confidence that these estimates are reasonable. But again, the point is you should invest with your eyes wide open, and you should always run the numbers out to their logical conclusion. So if we're looking at high growth rates, so let's go back to forecasting. Let's get rid of some of those crazy years. If we're looking at 27% growth, then this stock could easily still make you very attractive rates of return for the next couple of years, even if it reverted to the mean. If it continued to trade at its current multiple of over 36, so we could just, we'll use 37 right here, then you can see that the stock would give you the opportunity to make over 25% a year annualized. NVIDIA sits as a very powerful growth stock right now, and there's still time to buy it, especially after the weakness we've seen so far this year, where it's fallen below its normal PE line. It could be an attractive long-term buy. But with caveats, there is risk in buying any of these stocks at these high multiples. They must deliver exceptional results for you to make any money. If they falter at all, then you could end up losing a lot of money. Because again, that's the risk of buying stocks with essentially no dividend and just betting purely on high growth. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs. Hope you enjoyed this video. The two stocks that I would consider investing in here today if I was an aggressive investor would be Eli Lilly and NVIDIA. Palantir, I would probably sell it if I owned it, or at least sell a portion of it, as I mentioned in the video, because its valuation has gotten far beyond what even the growth potential of Palantir could make you in the forthcoming years. Hope you enjoyed this video. If you did, again, give me a like, ring the bell, subscribe to the channel, and take a look at FastGraphs. What a great, efficient way to evaluate stocks. The Fundamentals Analyzer software tool. I wouldn't invest in stocks without it. Thanks for watching.